Hi everyone, and welcome back to my channel. Data moves fast, but the market moves faster. I'm Dean Aronovich, your commercial real estate insider. Whether we're breaking down the latest market shifts or uncovering the secrets to your next big deal, we're turning complex specs into massive opportunities. Let's get to work. If you're looking at the Greater Toronto Area multifamily real estate market in 2026, you're probably seeing some massive contradictions. On one hand, the market is entering the year with neutral momentum, balancing a severe lack of housing supply against some really tight regulatory headwinds. In fact, transaction volumes in 2025 dipped by 5% year over year, landing at $2.2 billion. But don't let that fool you into thinking the big players are sitting on the sidelines. We are still seeing massive deals close, like Lankin Investments dropping $247 million on an 800-unit portfolio out in Brampton. So where is the smart money actually going in 2026? Let's dive into the roadblocks, the silver linings, and the number one investment play you need to know about. First, let's talk about why buying existing apartment buildings is incredibly tough right now. In the GTA, cap rates are currently hovering between 4.5% and 5.5%. But the absolute biggest hurdle for investors is Ontario's 2026 rent increase guideline. The guideline is strictly capped at just 2.1%. If you are an investor looking for a short-term income play, the math just doesn't work. This strict rent cap severely limits your net operating income growth on existing tenants. And to make matters worse, vacancy rates are actually forecast to rise. Vacancy rates are hitting 4.5% nationally by the end of 2026. You might be wondering, wait, isn't homeownership affordability at an all-time low? Shouldn't that mean everyone is renting? Yes, historically that drives strong rental demand. But right now, a massive wave of condo investor units is entering the rental pool. This is creating fierce competitive pressure and putting a hard ceiling on rent growth. Existing buildings are a tough sell. But on the flip side, the GTA is facing an absolutely massive supply deficit. Condo pre-sales have effectively collapsed, and the pipeline for new purpose-built rentals is alarmingly thin. We are structurally widening the housing gap every single day. But here is the silver lining, and it's a big one. The government is finally making a move. The Canada mortgage bond cap is officially rising from $60 billion to $80 billion in 2026. This is a massive policy shift. This expands the financing capacity for rental housing, theoretically unlocking much cheaper construction financing for multifamily projects. So if high financing costs and the 2.1% rent cap are crushing the profits on existing buildings, what is the strategy? The strongest play for 2026 is simple. Buy the land, not the building. Savvy investors are shifting focus to land banking and rezoning, specifically for purpose-built rentals. By leaning directly into the structural supply deficit, you avoid the headaches of existing capped tenancies. By taking advantage of the expanded Canada mortgage bond financing and combining it with City of Toronto incentive streams, you are perfectly positioning yourself. Investors are positioning for massive long-term growth, completely bypassing the immediate market headwinds. The days of buying an old building and jacking up the rent are over. 2026 is the year of the builder. What do you think of this shift? Are you looking into land assembly, or do you think the condo market will bounce back? Let me know in the comments below. If you found this breakdown helpful, hit that like button. Subscribe for more real estate deep dives.
Whether you're looking to buy, sell, or invest, don't leave your equity to chance. My team and I specialize in navigating this specific market data so you don't have to. Reach out via the link in the description, and let's put a high-level strategy behind your next move.
Thank you for tuning in, and see you on our next deep dive.